Bismillahirrahmanirrahim. Assalamualaikum warahmatullahi. Okay, today I'm going to explain to you about corporate governance. Okay, basically the coverage for this topic will be, okay, we will look into the definition, okay, of corporate governance and some development of corporate governance. And then you need to know about the theories of governance and also the approaches taken for the corporate governance. Okay. At the end of the chapter, you should be able to explain what corporate governance is all about. And then you need to be able to describe the development of corporate governance in Malaysia. And then describe the corporate governance in the UK, what are the related reports. And then the corporate governance in the US, you have the Sarbanes-Oxley Act, the Organization for Economic Cooperation and Development, that is the OECD, Principles of Corporate Governance, as well as the International Federation of Accountants. Okay. And then you also need to know about the theories of corporate governance. So basically you need to know about the agency theory, the transaction cost theory, the stakeholder theory, as well as the shareholder theory, and last but not least is the stewardship theory. Okay. There are various definitions of corporate governance. Okay, you can turn back to the Cadbury Report 1992, the OECD Principles of Corporate Governance 1999, revised 2004. And then in Malaysia, we have the definition given by the Malaysian High-Level Finance Committee in 1999. On top of that, you can also refer to journals, okay, some journals and that provide definition of corporate governance. But these are the authors for the journals. So you can refer, when you want to refer to a journal, then you refer to the author's name and the year in which it is being published. Okay, that's how you refer to a certain article. Okay, so if you look at the definition of corporate governance, okay, in the Cadbury Report, it is stated that the final report, that is the financial aspects of corporate governance, or usually known as the Cadbury Report, was published in December 1992 and contained a number of recommendations to raise standards in corporate governance. So that means you are looking, it comes out in 1992, it's known as the Cadbury Report, that provide recommendations, okay, recommendations about the things that you need to do for the corporate governance to enhance the standard of corporate governance. So the Cadbury Report 1992 has provided us with the legacy of definition of corporate governance. So in the Cadbury Report, corporate governance is stated as the system by which companies are directed and controlled. So that means, what is corporate governance? You are actually looking at the system of which it looks into how the organizations or the companies are being directed and controlled. Who direct the directions of the company? Is it the shareholders? No. Companies are being directed by the managers or the directors. So you are looking at the system by which companies are being directed and controlled by all these board of directors. Okay. If you look at the OECD, okay, it is the rules and regulation that govern the relationship between the managers and shareholders. So you are looking at the relationship between the owners and the directors or the managers of companies, as well as stakeholders like employees and creditors. So you are looking at the relationship among these various stakeholders and the one that manages or in charge of the company's day-to-day operation. Okay. Also, its revised definition look into the procedures and processes according to which an organization is directed and controlled. It's basically you are looking at how the organization is being directed and controlled. So the corporate governance structure specifies the distribution of rights and responsibilities among the different participants in the organization. So that means you are looking at the rights and responsibilities. Okay, and then who are the different participants in the organization, that such as the board of directors, the managers, the shareholders, and other stakeholders, and lays down the rules and procedures for decision making. So that is basically what corporate governance is all about. Also, if you go to the OECD website, you can see that corporate governance Good corporate governance helps to build an environment of trust, transparency, accountability. So that means, why do you need to have this corporate governance? It's all about building a trust, and then you have to be transparent. That means who manages the company? That means the managers or the directors. So the directors, they have to be transparent. They have to inform the shareholders as well as the various stakeholders, and then they have to be accountable. Why? Necessary for fostering long-term investment, and then so that you will have financial stability, you will have business integrity, thereby supporting stronger growth and more inclusive society. So that is basically why you need to have a good corporate governance. Okay, it helps various parties, not only the stakeholders or the shareholders, but also the how they manage the insiders or the directors of the companies as well. Okay. Now, this is another definition, okay, by journal article. So you can see Batch, Bolton and Rowell 2002 define corporate governance as being concerned with the resolution of collective action problems among dispersed investors and reconciliation of conflicts of interest between various corporate claim holders. So you have, this is the definition. And then also you have by Oki 2001, corporate governance is defined as structure of rights and responsibilities among the parties with a stake in the firm. So you are looking at the right and responsibilities for among the parties, whoever that have a stake in the firm. Means about the relationship, about the structure, about the rights of various stakeholders that you have. Okay, and then okay, who is the Malaysian Code of Corporate Governance targeted at? So basically, the Malaysian Code of Corporate Governance is specifically targeted at the companies listed on Bursa Malaysia. And then how do listed companies comply with the Malaysian Code of Corporate Governance? That means they have to explain, they have to disclose, they have to inform in the annual report about how they have complied with the recommendations of the corporate governance. And then why is Malaysian Code of Corporate Governance been revised? So the Malaysian Code of Corporate Governance was revised after taking into account the changing dynamic markets as well as the international development and the need to continuously recalibrate and enhance the effectiveness of the corporate governance framework. Okay. So if you look in Malaysia, the definition of corporate governance is defined by the High-Level Finance Committee report in 1999 as the process and structure used to direct and manage the business and affairs of the company towards enhancing business prosperity and corporate accountability with the ultimate objective of realizing long-term shareholder value whilst taking into account the interests of other stakeholders. Okay, this is the definition given. Okay, that means the general idea is that you look at how the company is being directed, how the company is being managed, okay, or to direct and manage the business. And then why do you need to look into that? Because you want to enhance the business prosperity. And then you want to make sure that the corporation, the units, the business organizations are being accountable. You need, means they have to be, you will have the accountability, you have the transparency. Why? You want to make sure that the business will be prosperous in the future, and then you make sure that you will achieve the long-term objective, and you can create value to the organizations and also to the shareholders. Okay, you look into the long-term shareholder value, and then not only the shareholders, but you also look into the interests of your other stakeholders. So that is basically what corporate governance is all about.